Welcome to our CFP exam prep discussion focusing on securities regulation, particularly the Securities Acts of 1933 and 1934. Let's dive deep into these fundamental regulations that shape our financial markets. The Securities Act of 1933, often called the Truth in Securities Law, primarily governs new securities issuances in the primary market. Think of it as the birth certificate requirements for securities. The key principle here is full and fair disclosure. Many candidates mistakenly focus only on registration requirements while overlooking the crucial anti-fraud provisions. The registration process requires companies to provide detailed information about their business operations, financial statements, and potential risks. A common exam trap involves questions about exempt securities versus exempt transactions. For instance, government securities are exempt securities, meaning they're completely exempt from registration. However, private placements are exempt transactions, which means while they don't need registration, they still must comply with anti-fraud provisions. Moving to the Securities Exchange Act of 1934, this legislation primarily regulates secondary market trading and establishes the SEC. Remember that while the 1933 Act focuses on new issues, the 1934 Act governs existing securities trading. Students often confuse these distinctions on the exam. Let's break down a crucial concept that frequently appears on the CFP exam. The periodic reporting requirements under the 1934 Act include Form 10-K for annual reports, Form 10-Q for quarterly reports, and Form 8-K for material events. A typical exam scenario might ask about when a company needs to file an 8-K. The answer is within 4 business days of a material event, such as a CEO resignation or significant acquisition. One particularly tricky area involves insider trading regulations under the 1934 Act. Section 16 requires insiders to report their securities ownership and transactions. A common mistake is failing to recognize that insiders must return any profits made from purchasing and selling securities within a 6-month period, regardless of their trading intent or access to inside information. When studying these regulations, create mental connections to real-world scenarios. For example, consider Martha Stewart's insider trading case. While it's not specifically tested, understanding how these regulations apply in practice helps retain the information better. Here's a practical tip for the exam. When you see questions about securities regulations, first identify whether it involves new issues or trading of existing securities. This initial classification will help you determine which act applies and narrow down your answer choices. Another challenging area involves exemptions under Regulation D. Remember that Rule 506 is the most commonly used exemption. While Rule 504 allows raises up to $10 million, Rule 506 has no dollar limit but stricter investor qualification requirements. Candidates often mix up these numbers and requirements. The exam might also test your knowledge of broker-dealer regulations. Under the 1934 Act, broker-dealers must register with the SEC and maintain minimum capital requirements. A frequent exam mistake is confusing broker-dealer requirements with investment advisor requirements under the Investment Advisors Act. Lastly, always remember that these acts work together to protect investors. The 1933 Act ensures investors receive complete information about securities being offered, while the 1934 Act ensures ongoing transparency and fair trading practices. Understanding this overarching purpose will help you answer questions that require applying these concepts to new scenarios. These regulations form the foundation of securities law, and mastering their distinctions and requirements is crucial for success on the CFP exam. Remember to focus on the specific purposes of each act and their practical applications in protecting investors and maintaining market integrity.